2012 was an interesting year for us. On the one hand, we saw good sales of fruit from South Africa in terms of exports, which translated into good packaging sales, of course. We also saw a significant weakening of the rand by some 13% versus the prior year on the positive side, which saw a reduction in imports of raw materials specifically, which saw a benefit for our business. On the other hand, we saw muted GDP and consumer spending growth, significant pressure on input costs, particularly transport, labor, electricity, and other administered prices. And we also saw across the broad spectrum of South African industry a number of strikes and other industrial action which didn't have a direct impact on our business, but did have an indirect impact on the business. So in spite of all of those challenges, we've managed to deliver what we believe to be good results. So in all, our revenue rose by 10.9% in the year to 6.8 billion rand. Our underlying operating profit for the year rose 11.6% to 585 million rand in what was a tough year. We also saw our underlying earnings per share grow to 191 cents from 103 cents the year before. That was driven to some extent, well, to a large extent also by our trading performance, but we did have the recapitalization, the restructuring of our balance sheet just prior to listing in 2011, which needs to be understood when analyzing the increase in underlying earnings. A key measure in our business is, of course, return on capital employed, and we saw that increasing from 13.8% up to 16% in the year, which is above our target, our through-the-cycle target of 15% and well above our cost of capital. So all in all, we've seen a very successful year despite the considerable challenges. We saw our net debt reduce from 1.3 billion down to just over 1 billion rand, which means that we've got the firepower to really go out and grow the business going forward. If you look at our funding facilities, we've got funding facilities up to 2 billion rand, which gives us headroom of probably around 500 million, all other things being taken into account, to grow the business. And we look to grow our business both organically and by acquisition, where we find the appropriate opportunities, both in South Africa and also in the rest of Africa. Of course, always measured against the key metrics of return on capital employed and value for the shareholders at the end of the day. If we look at the individual businesses, just to give you some perspective, our paper business still constitutes about 75% in turnover of the total business, and our plastics business 25%. Our paper business saw revenue growth of just over 10% to 5 billion rand, and underlying operating profit growth of also about 10% to 562 million rand, which under the circumstances is very good. We managed to maintain the margin at 11.2%, and that was really on the back of stringent cost control through the business, of course increased volume growth. We saw our volumes grow in the paper business some 8%, and in the context of the environment we're operating in, we believe is good growth, thanks to import replacement, mainly on the paper manufacturing side, and export fruit packaging on the corrugated side. So in the paper business, a good performance. In our plastics business, we've also continued to make significant progress in that business. We saw revenue grow 12.8%, driven by volume on the one hand, but also by the recovery of prices or of costs in raw materials, which we were able to see in the prices of the product. The underlying operating profit in that business grew 16.7% to 117 million rand, which illustrates the progress we're making in reorganizing and developing our plastics business, which we're very pleased with. We'll continue to focus on the optimization efforts we've already begun in the plastics business, and we believe that those are starting to yield good results.